Welcome back to Yahoo Finance Live, everyone. We're tracking shares of NFLX, Netflix. Those shares, as Alicia Keys would say, fallen in after-hours trading by more than 20% following its Q1 earnings report. The company lost subscribers for the first time in 10 years. For more analysis, let's bring in Santosh Rao, who is the Manhattan Venture Partners Head of Research. Just your reaction on this headline number and, of course, the first time losing subscribers in 10 years for the streaming giant.
Hi, thanks for having me. Well, this is a body blow to the bull case. Definitely the Netflix story, the subscriber story. Netflix was all about subscribers for so long, and now you saw that, and it's really taking it on the chin here. And it was bad across the board. So let's wait and see. Let's see what the conference call says. Why did this happen? But it looks like a systemic thing across the board. The subscriber account was down. So let's see. Is it churn? Is it competition? Is it the pricing part of it? Or what exactly is going on? And what are they saying? And how are they preparing for the future? But net, the bad number. And everything has to be re-rated. The whole story has to be re-evaluated from a lower base now. I mean, the multiples are getting compelling at this point, but we need to see that the growth story is still intact and they have a strategy to tackle the challenges ahead.
Santosh, they lost 1 million subs with discontinuing service in Russia after the invasion of Ukraine. All that aside, a net loss of 200,000 is devastating for them. What changes might they make in the face of this?
Well, I think they have to continue what they're doing. I mean, they had a whole slate of new releases, and they have some. Hopefully, there will be more stickiness down the road in the later half of the year, so that'll catch up. Content is important, and that's the key for their key differentiation at this point. Competition is there. They are spending quite a bit. They will be spending $8 billion, so they may have to optimize that. So net, I think they need to figure out where they're going wrong. But at this point, they should continue. But then more than that, they need to get into some other sticky things like more gaming, maybe sports, advertising revenue, of course, kind of go on all these additional levers that they need to pull, because this is not working. The traditional core business may have peaked, especially in their core markets. Emerging markets are still good, but we need to see. I mean, APAC and EMEA regions are still underpenetrated, so they need to go there with a more localized and better strategy, with better pricing as well. I don't know if the pricing is sticking. We'll see whether that's helping them or not, because they are the highest on the street overall in terms of the pricing, monthly subscription. So we'll see. They need to look at a lot of things. Back to the drawing board, really evaluate where they are really going down, getting hit badly.
You raise an interesting point about emerging markets. Netflix clearly has a lot of international content that it continues to put on its platform. Where should it be looking then in terms of expansion for more subscribers?
Well, India is a great market. Japan is a great market. They need to keep on growing there. And those are the key areas. And even here, see, overall, there are about 700 million broadband homes around the world. So it's totally underpenetrated. Those regions are underpenetrated. There's still margin to grow. Subscription is the business. Streaming, rather, is the future. But they need to. The incremental subscriber is not going to be easy to acquire. So they need good content, continue with what they're doing. And the content they have to spend. That's the key to pull people in. But they need more sticky factors. So I would say emerging, Japan, India, and all those areas which are underpenetrated so far, they are the prime markets to attack. And even though the ARPU is low there, but they need to get the volume there as well. And then stay in the core market is also kind of compete. Right now, the new competition is coming up, so you can feel the pressure there. But if they stay on the game, I think they can establish their niche in there in the core markets as well. But overall, they need to grow and they need to compete, and that's the new reality for them.
Santosh, I want to come back to something that you were mentioning a moment ago, and whether this is something across industry that we should look out for over the course of this earnings season, or if this is specific to Netflix. But I'm tracking shares of companies like Disney. DIS shares are down in after-hours trading by about 3.4%. I'm looking at my screen as well at WBD, which is, of course, the newly formed Discovery Inc., if you will, that is going to also continue to play in this space. And so with that in mind, how much of this do you think we will see show up in some of these other streaming giant earnings reports?
It will be across the board. I mean, it's not just Netflix in particular. I think it's going to be, you're going to see the numbers across the board come down because that's the new reality. And don't forget, you have the macro factors as well, and inflation and all that. This is a discretionary spend as much as it's required and popular. It's an extra 30, 40 bucks or whatever, 16, 20 bucks out there. And if you spend two or three apps, it's a lot of money and people are cutting back. So that I'm sure is also playing into this whole demand side of the equation. So let's see what it is, but I expect across the board reductions in the subscriber count.
And perhaps they explain that in their letter to investors that says COVID clouded the picture by significantly increasing our growth in 2020, leading us to believe that most of our slowing growth in 21 was due to the COVID pull forward. So you may see a similar statement from other streamers. Moving forward, do we expect a model that includes ad-supported, free, or even lower-priced content?
Absolutely. I think looks like they need to go there, even though they don't want to go there. I think looks like they may have to, if that's the only source, only good source to go to at this point. Even though they don't prefer that. I mean, Netflix is known for its ad-free content, which is good, but at some point you have to get real and say, you know what, we need revenues, and that's the big push on that. The bear case, if there is one, was can they maintain margins? Can they get the cash flow numbers? The free cash flow numbers that they were targeting, can they hit the subscriber count overall? That metric seems to be in real pain right now, the subscriber count. But if they can maintain their profitability, show the revenue growth, I think they can still be in the game. They are still the incumbent leader, so they can still manage that.
Santosh,
they still need to execute.
Very quickly, while we do have you here, because in not just a decelerating subscriber environment, but now a declining subscriber environment, as we've seen in these figures, what does that tell to you? What does that tell you about the price point that we're going to have to look at across the board and the adjustments that are going to be necessary there? We only have about 30 seconds.
Yeah, I think price points are important. I mean, if this decline was due to the price increases, I think you're going to see some pullback there as well, because at some point you have to get very optimized. You have to optimize the pricing point. So you will see, I think there is a cap to how high they can go, and they may have to come down more if needed to maintain their subscriber.
Santosh Rao, who is the Manhattan Venture Partners Head of Research, breaking down Netflix earnings with us here this afternoon. We appreciate it very much.